Good
while I
afternoon.
So
I am
welcome
if I
going
do
to
to,
my
Justin Peterson Presents the Ignite Illinois webinar series. Today we have the awesome opportunity to hear from Nate, and he's going to speak to us on advanced tax strategies.
All right.
Come on, Nate.
Thank
Hey
you.
guys, put some reactions in the comments. Yeah, there you go. There you go. Thanks, Nate.
There it is. Appreciate you guys. Appreciate everybody. Well, love hanging out with you, and this is a great time. And the last time we talked about regular tax strategies, which are a little advanced in of themselves. And today, I thought it'd be really good to talk about some of the strategies in the one big beautiful bill, which some of them are pretty, they're advanced in a sense. I'm gonna pull this up here so we can pull up the PowerPoint. They're advanced in a sense. They're also things that some of the things you've maybe have heard about, or some of the things that you might be wanting to learn more about. And so some of this might feel like a little like drinking, what they say, drinking from a fire hose. Some of it might seem over the top. So I'm gonna do my best to really kind of drill it down so that we understand as business owners how to utilize them and or how to communicate with our tax professionals as far as, hey, I was on a webinar and the speaker spoke about this. Can you tell me more? Can you tell me how it might be something that I can utilize in my business? Of course, I can't give you individualized tax advice, but I can certainly share these components of the tax code, because this was a really big deal as we were approaching the after the election and this bill getting passed, and what it means for you as business owners, as people who have families and employers. Those are all parts of the conversation on how to make sure that we're not paying the government 1 red cent more than we're legally required to. In fact, that's our vision statement for our company, the Income Tax Center, is we don't want you doing that. We want you paying just what you're legally required, not a penny more. And so part of that is being a savvy tax aficionado. Doesn't mean that you can do your own taxes necessarily. Doesn't mean that you're going to be an expert in taxes. It just means that you'll understand enough to ask the right kind of questions. Because so much of our leadership in business isn't always making decisions. We have to, but oftentimes it's just asking the right people the right kind of questions. And if we have the right people around us in our organization and outside of our organization, well, then that synergy of knowledge will help us to make wiser choices and better decisions that will ultimately lead to a healthier bottom line. And that healthier bottom line, our finances are the lifeblood of success in our business in terms of, it's been said that profit is the applause you get from your customers for doing great work. And so we want to be profitable businesses. And one of the areas of profitability is our taxes, even though we don't see it on our income statement. And I think that's why it's elusive, because we don't see taxes as an expense on our income statement. It's after the fact for most of our companies, because we're not taxed as C corporations. Now, if you're a C corp, it's a little different. So we don't think about taxes as a big expense, but it is. So that's why we need to be smart, savvy, pay attention, and understand these strategies. So I'm going to kind of just give you a little background as we start, and to give you an idea of what was the one big beautiful bill. Well, on July 4th, 2025, President Trump signed into law the one big beautiful bill, and it was nearly 1,000 pages, like between 800 and 1,000 pages. The law covered many areas: taxes, healthcare, immigration, social programs. Of course, for our purposes today, we're going to focus on what this means to you as a business owner from a tax perspective, from an employer perspective, and the legislation in and of itself. It was really the centerpiece of the president's second term. They combined what we call permanence for some popular 2017 tax cuts. When I say permanence, it doesn't mean it can never change. It just means it doesn't expire until a new administration puts something else in the law. Okay, so many of our tax laws that President Trump instituted in his first term were set to expire in 2025. And some of those were good for business. They were tax breaks for business owners and whatnot. And so many of those are extended indefinitely until another administration changes it. Some are temporary provisions, some are cuts to some programs, and some are in cuts of programs. And some folks have voiced even in this series, those cuts have negatively impacted their businesses. So it's not all roses with the big, beautiful bill. And we're going to go through different scenarios with that so that you have a little more understanding and certainty in your tax environments. Also, a sense of urgency because there are going to be some critical deadlines for some of these expiring provisions, and it's important for you to understand that. So what I'm going to do is I'm going to start with one of the main provisions that a lot of people wanted to know. What is happening? What is happening with our depreciation and bonus depreciation? I don't know if you've ever heard this term before, if you're familiar with the term. If you have, put a yes in the chat if you've heard of depreciation or bonus depreciation. This is a really big deal for the new administration and the laws for you as a business owner. Thank you, Don. And how to maximize your benefits. Now, what does that mean? So bonus depreciation, or just any depreciation, it's just another term for qualifying business investment equipment. Think of equipment, think of furniture, think of certain kinds of improvements, think of vehicles, certain kind of vehicles. We're going to talk about them. Now they can be fully expensed right away. So you don't have to wait for years for what we call depreciation schedules. In other words, the useful life of an asset over time to take the value. So what does that do? Why is that important for you as a business owner? And I know some of this might sound boring, but it's really important. And how it affects you from a financial perspective, that's the part that shouldn't be boring. That's the part that should be exciting, because if we can find ways to put more money in your pocket, that means you have more financial resources to run your business more effectively, have all the resources and tools to create a great experience, and then also support and feed your families and give them what they need. And of course, your employees, and so on and so forth. So all this makes sense. So essentially, what that does is, if you can take an expense for items right away instead of carrying it over 5 years of the useful life, that creates immediate cash flow advantages for expansion, for upgrades, new purchases, any of that stuff. So this bonus depreciation, I'm going to go into some detail on it. What it means is this: any tangible property with a useful life of 20 years or less, machinery, think of computers, think of office furniture, equipment, leasehold improvements, vehicles, they are eligible for possible depreciation in full first year. In other words, instead of saying, okay, you buy $150,000 worth of new machinery, you're a contractor, in December of this year, and you put it in use this year, instead of taking that value over 7 years, in other words, there's different methods. We call them MACRs, or modified accelerated cost recovery, and straight line depreciation. What did you say? Straight line depreciation. So 150,000 over 7 years, you take 1/7 of it every year for 7 years. Well, you can get a small deduction every year over the next 7 years. Instead of that, you can now take the full $150,000 and deduct it right off that first year. That means you pay less taxes. That means you have more cash. So if you're a business, say you have a dental practice and you install $80,000 in new exam chairs and computer systems in late this year, you can write off the entire amount that year, of course, barring any other, issues. Now, this is general, of course. Every business is different, but this is how the law works. So people ask, well, is this just for new property? No. New and used property qualify as long as the first time your business has used it. Okay. So you might ask, can I buy a used truck from another business and still expense it? Yes, as long as your business hasn't previously used that asset. Now, here's the thing: that asset must be purchased and placed in service, which means delivered, installed, ready for use before year-end to claim the deduction. So you can't buy something on 12/31, receive it on 1/2, and deduct it. You have to it has to be delivered, installed, ready for use before the end of the year. So ordering December 30th equipment's not enough. It's got to be on site, installed, and operational. It's very important. Now, that's equipment, whatnot. People ask all the time, what about vehicles? And I'm sure some of you have heard this. If you've heard this before, say yes. Should I go buy a heavy truck over 6,000 pounds before the year's over, right? Have you heard that one before? So my accountant told me to go buy a truck or go buy an SUV. I got to buy it by 12/31. You guys have heard that. I'm sure many of you have. It's very common. In fact, we do taxes for a lot of car dealers, and they wait for accountants like us to send our clients to their business. Big running joke on this provision, because it's true. The law preserves that special rule for vehicles, heavy SUVs and trucks, and it's basically over 6,000 pounds gross vehicle weight, qualify for what we call full expensing, depending on the percentage of business use. While passenger cars under that weight face limitations, if you will. So say you have a heavy vehicle over 6,000 pounds, and this could be, a lot of SUVs, a lot of full-size trucks. You use it more than 50% for business. It has to be more than 50%, and you can write off, you can deduct that percentage of business use. So keep that in mind. Also, it also depends on the percentage of business use. So you might say, oh, well, I used it 70% of the time. Well, there's a 70% of that deduction. Now, here's a little tax, not trick, but secret, if you will. Well, say you bought the vehicle December the 25th. Of course, that's Christmas Day. Maybe you don't buy it December 25th, December 26th. And you just use it for those 5 days for business only for the rest of the year. Well, guess what? It's 100% business use. So even if you only drove that vehicle, I don't know, 100 miles or 50 miles, it doesn't matter how many miles you've driven. It's the percentage of it that's for business only. And so say you paid $50,000 for that vehicle. Well, guess what? It's 100% business use. It's over 6,000 pounds. Then the deduction looks like it would be for the full $50,000. Isn't that amazing? You only use the vehicle for 5 days out of the whole year, and you get to deduct 100% of it, 50,000 or 100,000 or whatever that number is. So a good strategy might be, and then to get it toward the end of the year. And another thing is that you may even find better deals because dealers are wanting to get rid of vehicles, whatnot. Now, I know many are in Illinois, but if you're in Missouri, you may have to pay personal property tax on that vehicle for that year as well. So you have to weigh it out and see if it's a benefit to do that versus the personal property tax. So hopefully that's a nice little tax tip for you. Same thing with any type of vehicle under 6,000 pounds. You still get a deduction. Say you bought a $65,000 sedan under 6,000 pounds. Deduction just capped for the first year. And so it's like around $20,000, which is still decent. So it doesn't mean it just goes away. And thank you, Don. That's right. Not land. You can't do land or buildings for that. Now, you can do cost segregations on buildings, though. So cost segregation strategy would allow you to extract the cost of improvements and building improvements that have a useful life under the full life of the building, so 20 less years, and then that can qualify for bonus depreciation as well. So that's a very useful tool. And what's a cost segregation? Cost segregation is simply where a company will segregate, or they will separate the capital cost, long-term costs versus the costs that are available for bonus or immediate depreciation. So we see folks do that all the time. So say you bought a $300,000 building, and that building had 30% cost segregation, which allowed for bonus depreciation. Well, that's $100,000. So $100,000 of that building may well be available to you to reduce your total taxable income by in year one. So cost segregations they have they're usually like anywhere from like $2,000 to $5,000. They can vary, but generally it can be worth the cost of the report to provide to your accountant and run that. Thanks for providing that, Don. That was really helpful. So you can see this bonus depreciation thing is a big deal. And it's something that we as leaders should take into consideration. Again, contact or speak with your tax accountant, your tax strategist, and run some numbers with them. We've got a lot of our clients at the end of the year, we run numbers on that bonus depreciation and seeing if it's going to be a benefit to them. I never recommend just to buy something because you're going to get a tax deduction. You know, that's one of the worst, I think, pieces of advice is to make a purchase for an asset that you're not going to utilize the benefit of it because, oh, I'm going to get a tax break for it. Because if you're not going to utilize it and there's not going to be any benefit to it, then now you don't have the cash. You have an asset that's non-performing. So even if you were paying 30% in tax, well, then you'd still have 70% of cash. And 70% of something's better than 100% of nothing. At least that's what my math says. Does everyone understand that? Don't just go out and buy stuff at the end of this year because it's going to be, oh, I'm going to save on taxes. Buy it because you're going to use it. So my philosophy is, here's what I would recommend to you, especially with this depreciation piece and buying assets and for your company. Anything that you're going to purchase in the first quarter of the year, whether it's a piece of equipment, whether it's a vehicle, or anything that would qualify for this depreciation, then buy it and put it into service by 12/31. So I'll go around my office and I'll ask the team members, hey, is there anything that is ready to die, whether it's a printer or a monitor, or I just had one of my computers go out or some furniture that's ripped that we're going to toss or donate in the beginning of next year. I would rather you tell me now because then I don't have to wait a whole another year to get my deduction. It's very important. All right. So next, hopefully that explained the depreciation, the 100% depreciation. I know it's a weird concept, so hopefully you understand a little bit better now than before. 20%. Oh, is that still up? We have now 20% pass-through deduction is made permanent. What does that mean to you? Well, that means for those of you, back in the day when the new Trump laws came into effect back in 2018, he allowed for a 20% tax break for you as business owners for net profit on your tax return. A lot of people don't think about it because their accountants don't even say anything about it. But partnerships, S corps, sole proprietorships, there's a 20% deduction on their what we call qualified business income or QBI. So you get that deduction. Most of them are just automatic. They don't think about it. But it was set to expire in 2025. Now it's locked in permanently. So now that 20% deduction for your qualified business income pass-through, it's permanent. So that's a good thing. That's a good thing for you. It gives you more benefit there. A new one for this year is this car loan interest. And so the car loan interest is now deductible on the tax return, which is a nice little benefit. And so when you talk to, and this is for personal vehicles, of course, business vehicles are going to be right on the business tax return, but for personal vehicles, so that's a nice little plus. Make sure to keep that notation and talk to your tax accountant, or make sure if you're doing your own taxes that you don't miss that one come tax time. All right, moving right along. So here's some family tax provisions that I thought I'd bring up for you as well. So we have lower rates and higher standard deductions are now permanent. So what does that mean? That means that you have the lower tax rate from 2017 and the larger standard deductions are static now. So like, for example, what's the important piece of this? It provides more what we call predictability for structuring your wages, your dividends, your distributions. So say, for example, there's you're a couple with $200,000 in taxable income. Well, you can confidently plan future years without fear of higher tax brackets. And so, same thing if you're a business owner and you balance W-2 wages and dividends, the rate schedule is going to remain the same. So that's a plus. The child tax credit is now also increased to $2,200 per child. So that's a plus. It's indexed to inflation. Now the refundable portion is still capped at $1,400. So if you want to claim, to claim that, both the taxpayer and their spouse, they have to have Social Security numbers. So say, for example, a family of 3 children, you're going to get $6,600 in credits, and a newborn, say you had a newborn in December 2025, that child qualifies as well if issued a Social Security number. So. Does every child need a Social Security number for this? Yes, and so do the parents as well. So that's that one. Estate tax exemption. So that's now higher now, $15 million per person. So for those of you, I'm not there yet. For those of you who have 15 million or 30 million as a couple in total estate holdings, now that exemption is now $15 million per person. So couples can transfer $30 million without federal estate tax. You say, Nate, we're not quite there yet. Hey, who knows, right? You can, it takes vision. The old saying in Proverbs 20:19, without vision, the people perish, but with vision, they thrive. So, we're only going to go as high as we can see. That's as far as we can go. So if that's a goal of yours, hey, put it out there and start stepping toward it. All right. Next, I wanted to bring up, and I don't know, did I bring up? Let's see the SALT here. Yeah, I don't think it's on my. Let me see my list here. Yep, it's not on here, but I'm going to share it. What's called the SALT deduction. So this is where your state and local income taxes. There used to be a cap of $10,000 that you could deduct, especially for those of you in Illinois who own a home. You pay high taxes on your property, your home. Well, you had a maximum of $10,000 that you could deduct for Schedule A, your itemized deductions. Well, now that is up to $40,000, which is very good. It's a much higher benefit than it was at the 10,000, which means that you can deduct more of your state and local taxes, including your real estate tax, if you have personal property tax, if you have your obviously your wages, your income tax that's withheld. So all those taxes qualify. So that's a good thing. Now, it does phase out at $500,000 or $250,000 if you're single. In 2030, it reverts back to $10,000. So even though high income earners don't have a benefit, it adds up, especially for folks who pay higher taxes on their residences. So that's a plus. And it's not on here, but seniors, you get a tax deduction. 65 and older get an additional $6,000 on top of their standard deduction through 2028. So if you're 65 or older, congratulations. You're going to get a higher standard deduction by $6,000, which just means you pay less taxes. Now, what does it mean for you as a business owner or employer? Well, all of these provisions, they can simplify what we call long-term tax planning. And they also impact your employees, especially in high tax states with dependents. And if you help your team to understand these changes, it could very well improve their morale. So it's good to have conversation around this. I want to talk a little bit about overtime pay. This is new for this year. And so overtime deduction. So the law introduced several what we call targeted tax breaks for workers and families. This is good for you as an employer. If you do have employees, the premium portion of overtime pay, which is that half in time and half deductible, is up to $12,000 per year. So what does that mean? So for people who have W-2s, if you have W-2 employees, not a self-employed income, so say, for example, you have a worker who earns $10,000 in overtime premiums. That $10,000 is deductible. So if a child working in a family store, say you have a child will be working in a family store, earn 6,000 overtime premiums, it's deductible. So, the big question is, does this eliminate all tax on overtime? No. Base wages are still taxed and the payroll taxes do still apply, but it's a plus. And then, of course, tips. I don't know if you've heard about this, the tip deduction. So now employees can deduct up to $25,000 of the reported cash or charge tips. This is important through 2028. So tips are still reported for payroll purposes, but the deductions will offset federal income tax only. They're not FICA, so Social Security, Medicare, no. So say, for example, you have, if you're in a restaurant, you own a restaurant, and I'm sure some folks that'll be watching this do. Your server reports $20,000 in tips. Well, they owe no federal income tax on that amount. That's great. A bartender, say they report $28,000 in tips. Well, what does that mean? So the first $25,000 is deductible and $3,000 remains taxable. So all good things for this particular, demographic and this type of worker. So those are all pluses. And then there's the new Trump account for kids. I don't know if you've heard of this or not. So kids born 24 to 28, and every child born 24 to 28 receives $1,000 government-seeded savings account. So parents can also contribute up to $5,000 annually until the child turns 18. Now, the contributions are not deductible, but the growth is tax advantaged. What does that mean? That means that withdrawals for education, for a first-time home purchase, or retirement, they don't have tax on the growth. In other words, the interest that's earned. So kind of like a Roth IRA, or perhaps also like a MOST account or an UGMA or a Coverdell, or the tuition ones. 529 plan, we call them. So that's a plus. Now, so a family, say, contributes $5,000 annually for 18 years with growth, that account can exceed $150,000 by adulthood, and that doesn't include interest earned. So anyway, so that's a plus. If a parent contributes $2,000 annually for 10 years, by the age of 18, a child could have like $30,000 for college. So for you as a business owner, what does it mean? So you can highlight these provisions as benefits for your employees, especially younger staff or those with families. And so they may not see the direct business deductions you do, but these new credits, they could help you retain or attract new talent. So that's a plus. All right. Is everybody falling asleep yet? Oh my goodness. Nate, the other one it was so exciting, but this is so boring. Hey, it's important. All right. Okay. Good stuff. Thanks, Don. Appreciate it. Don's my Vanna White today, looks like. All right. All right. All right. I want to talk a little bit about a couple other accounts too. This is all part of the tax bill, and there's all some tax planning pieces. Thank you everybody for your support. It gets lonely sometimes when you're just speaking this, when you don't have, I love to get interaction. So if there's anything that's speaking to you, please put in the chat. Yes, April. Yes. Well, not anything, but basically, yes, that there's a lot there. And, but 1231, you want to purchase and begin to put into use anything that would qualify. And you can look up bonus depreciation items online. Okay, I want to talk about HSAs next. So the law broadens access to the HSA, a health savings account, so that they're more practical for families. So starting in 2026, this is important. Bronze catastrophic marketplace plans qualify for HSA use. So that's really good. So, and this is basically a tax-free money for you. So what is an HSA? It's a health savings account. So what does that mean? That means if you open an HSA and you qualify, say, for example, you have $5,000 in medical expenses this year. Well, you can put the $5,000 into the HSA, use the HSA to pay the bill, and then you get to deduct the $5,000 off of your taxable income. So that's a huge benefit. right? And so depending on what your total if you're single or if you have a family, that will change the amount that you can deduct. This expansion expands the eligibility to millions of households now. So that's a huge benefit. That's right, Shalita, huge benefit. So a self-employed designer on a bronze plan opens an HSA, contributes $8,000 annually. Boom, that's deductible. By the way, you don't have to use the money in the HSA that year for medical costs for it to be deductible. You just have to contribute to it. That's an important piece there, because you may not have it, but you may be saving up in that, and also that interest that's accruing in that HSA. If it does accrue interest, as long as it's used for those medical costs, there's no taxability on that. So again, a family has a catastrophic plan and contributes to that $15,000. It can build savings for healthcare. This is great stuff. Now, the direct primary care fees are added as eligible expenses. So that's now reimbursable with HSAs. And some of this you might feel like this is over the top. I don't really understand it. Hey, you know what? It's okay. Just start to learn the language a little bit, and then ask your accountant. Hey, or your HR, your payroll folks, or your insurance folks. Say, you know what? I watched your webinar and I learned a little bit about this. Can you tell me more? So, because any one of these could be a whole hour of deep diving, but just to give you an idea, so the direct primary care fees, they cover things like concierge subscription, doctor agreements. They're not insurance premium coverage. So, for example, if you're a business owner and you pay $2,000 for concierge medicine using an HSA fund, or a family pays $150 a month for a direct care membership funded with the HSA contributions, that can be deductible. And then, of course, the telehealth services now have permanent eligibility even before the deduction is met. So if you are an employee, has telehealth services, urgent care visits or whatnot, you can pay with HSA funds. Retiree, if you're a retiree and you have use HSA to cover telehealth consultation under a high deductible plan, it's also deductible. So all of those are all pluses. So what does this mean for you as a business owner or an employee? Well, offering high deductible health plans paired with an HSA, it can be it becomes more attractive. And then you can provide payroll tax savings and give your employees tax-free dollars for healthcare. And so that's never a bad thing when it comes to morale and retention for your people. All right. Next, I want to talk a little bit about things that are expiring. It's so important to know, if you're in the market for you or your company for a few of these things, to get this on your radar, because you may not have known this, but there's some certain energy and vehicle incentives that now have deadlines, and they matter more than ever for these tax breaks. So, for example, solar and battery tax credits, they end December 31st, 2025. So that 30% residential energy credit, it ends after December 31, 2025. That's something I wish would have stayed, but alas, I guess not everything stays. So it's got to be placed in service by the end of the year, 2025, not just purchased. So if that's something you've been considering, adding solar, definitely consider moving more quickly so that you can get that tax deduction. Because if the project delays until, say, January 2026, you may lose that credit. EV credits, those actually are going to expire in 6 days. So if you're going to buy a vehicle and get the electric credit, you better hurry, because time's about to run out. And now the EV charger credit, that goes until June 30th of 2026. And that applies to both home and business installation. So that's how that works. Okay. So if you're planning as a business owner or just an individual to solar those EV investments, you got to act quickly. Missing those deadlines, it can cost you thousands of dollars in credits unless you move fast. I did want to talk a little bit about social programs too. So these social programs, the law is making some historic cuts, as you may have read, to Medicaid, to SNAP, student loan programs. So Medicaid, that funding's been cut by about 18% over 10 years with that new 80-hour a month work requirement. So that's important to know. Um, and of course, there's that 6-month eligibility check that's also with that. So a part-time worker at 60 hours a month, they may lose Medicaid. And some small employers are going to face some pressures from workers who are going to be seeking more hours to qualify. So you should know that as an employer. And then the SNAP programs, the food assistance, that's cut by 20%. Again, work requirements are expanded now to age 64 and also to parents of children who are 14 and up. So say, for example, you have a 60-year-old part-time worker. They must meet the new thresholds to retain their benefits. Or perhaps you have working for you a parent with teenagers. They're going to lose their benefits if they don't meet the work rules. And then similarly, student loans, the income-driven repayment plan is getting rolled back. So that means borrowing limits for graduate and parents' loans are also reduced. So graduates may see monthly loan payments double without the IDR, and so the Parent Plus loans can no longer defer during unemployment. So these are things that are important for you as a business owner or even as just a person who has children and family. Your employees may experience some financial strain now, and they're going to look to you possibly for stability in their benefits, their wages. So we can expect a higher demand for employer health plans, possibly some turnover pressures. All of that's important for you and for me as employers to understand how to best serve our employees. So some of the things in the plan are you can see that they have an immediate benefit, sometimes not so much. So what does the big picture look like? Well, the big picture, this bill changes America's fiscal and political landscape. It really does. It has a national debt impact. So the CBO projects that there's going to be $3.3 to $4.5 trillion added to our debt over the next 10 years. So policymakers will continue to thank you, Tabitha. Policymakers will continue to debate entitlement reform. That rising debt is going to increase our borrowing costs. These are challenges we're going to face as a nation in some ways with this. Our distribution of benefits, the top 1% and households over 400K really are projected to gain the most out of this. So you as a business owner, you may save significant taxes, but employees may not see the same benefits, and some might even lose some ground. So it's important to be aware of that, mindful of that, and also have not just empathy, but continue to stand in the gap and make a difference for the people who we serve. And then also public perception. A lot of, some polls do show that most Americans think that the bill benefits the wealthy. So here's another thing. Employees, they may resent employer savings when they face reduced supports. So, that's important to know because, public opinion pressures, it may pressure policymakers to revisit some provisions. But what does this mean for you as a business owner? Well, this means to be aware of optics. Your business may save taxes while employees might feel more squeezed. So consider communicating with them, supporting them, having the strategies to work together. These tax provisions are not just about how I save money. They're also about how I lead well in an organization, how I find myself worthy to lead. And I am mindful of the needs of not only the business from a financial perspective, but also all the people who work with me and work for me so that we can work together and create an experience that is exceptional, not only for myself, but for everyone who works alongside of me. And that is around the world of some of the big, beautiful bill tax provisions pretty quickly here to give you a snapshot, an idea, at least drinking from a fire hose a little bit. And maybe if you've taken some notes, you can say, oh, you know what? I heard about this. I'm going to dig deeper. All right. That was advanced tax strategies, were they not? Oh, you're muted, Yolanda.
I didn't say anything. I was over here like, woo.
Oh, okay. I didn't know if you were saying something. I know, right? Woo, it's a
Yeah.
big one. These are advanced even for most accountants.
Oh, wow.
You know what I'm saying? Like this is heavy stuff, but this is a good group. They deserve it. They
Yes,
deserve this stuff, and it's important. You need it. Yes, the crash course for sure. The more you hear about it, the more you learn, the more you absorb, the more you know, the more informed you are. And it's been said like this: the educated mind cannot be enslaved. It's freedom for our minds to be educated and to be able to use that knowledge to benefit ourselves, our society, our families, our communities, and ourselves.
They just said she definitely took notes.
Okay, good. Good. Yeah. There's nuggets in there. Yes.
I actually looked at the new form. Is form A1 or 1A for the deductions on the taxes, the
Mhm.
tips, and
Mhm.
the overtime.
Yep.
So, which we'll be talking about payroll next week. So some of this information is going to be part of the W-2s that people are going to be receiving. So business owners, if you're using a payroll service or if you're doing it, you need to really make sure you're on top of the new stuff for that form.
That's a good point you make, Ann, because employees are going to try to figure it out and they may have questions, especially with those W-2s may look a little different than they've looked in the past, right, Ann?
Right.
That's good. Thank you. Any other questions or comments?
Hey, Nate, this is Don.
Hey, Don.
I was going to add something to the presentation a little bit. My background with grants, history of writing grants and such. And I believe it was in 2017 that tax law came into play where,
It was.
Yeah, so where the grants would become taxable income. And when you had talked about the bonus depreciation, one of the challenges I know that we were dealing with, and they had a special program for grants here through DCEO with the state of Illinois. These grant funds were being awarded, and in my case, we received grant funds that went into real estate, real property. And the challenge for others that had that very similar situation is that they did not have enough depreciation or bonus depreciation to help to offset, and we're looking to write a big check against those grant funds coming in. So imagine, if you would, $500,000 coming in, and then all of a sudden for construction of a building, and then all of a sudden you're realizing you got big taxes on that money because it's identified as grant funds being received. In our situation, we were able to work around that because we did have some concrete trucks, or I don't know, some heavy equipment we purchased of a comparable amount that same year. So we were able to utilize that bonus depreciation to help to offset that income that would have been recognized in that same year. But it was kind of, it was reality. It was a wake-up call, and I've explained this or talked to many of the grant recipients through this program, through DCEO, so that they're aware and understand, because that tax liability could literally wipe you out as a business if you don't understand the consequences of those dollars coming in, and if you don't have the money to pay, it could create significant hardship for you.
Good point.
Yeah, that's a great point.
So and that's why it doesn't make sense, because when you hear the word grant, you think, oh, this is a good thing, and it is, but it's not as simple as it used to be. Yeah,
very true. Yes, and that's why you have to, like, and I know you're savvy and you're always looking at around the corner with what could go wrong, but that's why it's so important to do the research, right, Don? Do the homework. Yeah. Awesome. Thank you for that.
I don't know what's going on. I have a sign that I've been signed out. I think this is me.
you're still here.
Yeah, I'm not going to click on the sign because I think if I do, it's going to log us
Sign us
out.
all out. Okay. Any other questions or comments? That's great. Taxes are complicated, but they shouldn't be something we should be afraid of. We should learn and embrace and not necessarily become tax experts, but know where to find the information or find the people who can help us with the information. Looking good.
Oh, I think this is a lot of information that everyone is taking in. I wonder if there's a way, is there anything on the IRS website where there's a cheat sheet or something that we can get?
Like I said, the bill was 800 plus pages. So
Oh, wow.
yeah. So this is actually a cheat sheet. In fact, I'll send over the PowerPoint presentation notes,
Awesome. Thank
and you
you.
can
That helps a
distribute
whole
them.
lot.
Yeah, that would be a good cheat sheet. At least it'll give the ideas around it so that they can that folks can find more information.
Right. And then you can, even if you're not fully you don't fully understand you can articulate it to your your tax person, and they'll know they should know what you're talking
They
about.
should know, or they should be on the radar,
Yeah.
Yeah. And that's what's great about these webinars, these times together, because they give you enough to where you can then take that and then utilize that somewhere else where it can benefit you with more due diligence.
Yeah.
Yolanda, I have a question for you.
Sure.
So each week, so my daughter is setting up her own business, and I think these would be important for me to get to her or have her have access to, see the series, as we go through the next few months or however many more sessions we have left. Are those all together in one location, or do I have to go through my emails and actually extract those to send them to her? Or what would be the best that I could do?
Process. Oh, I'm sorry for interrupting, but the process for anyone that thinks that this information is good for someone else is they could just shoot me the person's name, email, and phone number, and because it's being counted, and so you can send me that information and I'll send them the series up to date. And just know we have another round coming up in 4 weeks, 3 weeks.
Okay. And it's not a repeat, it's new material moving forward? Or is it repeating what we've?
It's we'll have the flyer out. I'll have the flyer
with
available.
a twist.
Say again,
repeating with a twist. It may be some of the same, but some additional.
There you
So
go.
like 102 instead of 101.
There it is. Yeah.
Yes. So I will, if you send me her information, or if anyone wants to send me information of the people that they would like to share this with, I would be happy, and I'll send it right out to them.
Great. Thank you.
You're welcome. Nate, do you have any closing, or anyone have any more questions?
No, it was a great time, and I'm glad to share. Glad everybody got something out of it.
Well, thank you, Nate. Thank you, everyone, for attending. I will see you all next week at 12 o'clock. Have a great week.
Bye, guys.